Hey everyone, in this video we're going to be talking about depreciation. So a common theme that we've talked about in previous videos is the distinction between capital account and revenue account. And it's important because in New Zealand it doesn't have a capital gains tax regime, so there's a lot of benefits to actually allocating, revenue items to capital accounts if it fits the definition, because then you won't pay tax on it unless there's some exemption like in the land and other topics we talked about already. Now, that's from the revenue side, right? There's obviously an incentive for it to be on a capital account. But on the other side, deductions, there's actually more incentive for the expense to be on the revenue side rather than the capital side. The reason is, if an expense is on a revenue account, and in one of the earlier videos we talked about, some of the facts that indicate whether an expense might be on capital and revenue accounts. So it's similar but different to the test we went through for revenue account. So as I mentioned, the incentive for taxpayers is to treat expenses on the revenue account because you're going to get an expense for that. An expense, and it's going to be an allowable deduction, which allows you to reduce your taxable income and therefore your tax paid. If you're on a capital account, you don't get to deduct the interest. Not interest. You don't get to deduct the expense, right? Because it's a capital item. It's not included. Now, that's not 100% correct, because what there is actually depreciation. Now, for some capital assets, not all capital assets, like for example land doesn't depreciate, you can actually get a depreciation expense, which is not the full amount of the purchase, but you basically get a percentage of what you paid for the asset over a period of the asset's effective life. Now, this isn't, as I mentioned before, this doesn't apply for all capital assets. It's only for those that fit in the definition of what depreciable property is. So let's start off with the flowchart up above, and this is the process that you go through to determine what is the actual dollar amount that you can claim as a depreciation expense for something which is on capital account. But to be more specific and more correct, technically it's an asset, which is a depreciable property, which is slightly different from a capital account because not all capital account items fit into a depreciable property. But almost all depreciable properties are on the capital account. So let's start off with the definition. So depreciable property is defined in section E6 as property that is in normal circumstances might reasonably be expected to decline in value while it's used or available for use, whilst in deriving assessable income or carrying on a business, or in deriving exempt income, which is out of scope. That's why land is not excluded in this definition. And we'll talk about some of the things that are also excluded. But basically, anything that's excluded doesn't fit the definition of expected to decline whilst in use, or maybe it's not connected to generating assessable income. So if an asset falls within the definition of depreciable property, a person must claim depreciation for that asset unless an election is made not to treat that asset as depreciable property. It is possible to retrospectively elect not to depreciate an asset that has not any depreciation claimed on it in previous years. This might be relevant, for example, where a taxpayer is admitted to claim depreciation, decides it's not worth the inconvenience of going back and amending 10 years worth of tax returns, whatever it is. So the following assets are excluded from the definition of depreciable property, most likely because they don't fit the definition of expected to decline in value. So the most prominent one is land, right? Because land, per tax regimes around the world, is universally expected to increase in value. Land doesn't generally decline in value because of the limited supply of it. So land is excluded from depreciable property. It can only be on capital account, but never a depreciable property. Some of the other examples that aren't depreciable property include trading stock, because that falls under the trading stock regime. Same with livestock. Same with property that will not decline in value as far, because owner will be compensated for any decline in value disposal. So generally property is depreciable asset, noting the difference between property and land. Land can never be depreciable asset, but property can, because the building itself can depreciate, but the land cannot. But that's not the case if the owner will be compensated for any decline in value disposal. Property that the owner chooses not to treat as depreciable property because they've made an election not to do so. Property where the cost is an allowable deduction for a person who is not the owner. So basically, if you own the property but you rent it out to someone else and they're entitled to the deduction for depreciation, not you, you can't claim it. Right, so only one person can claim it, and we'll talk about that in this later step over here. So when it's used or available for use, who actually gets to claim it. So just keep that in mind. Property where the owner is allowed a deduction for the cost under another provision. So again, you can't double count provisions. So if you're already deducting it somewhere else in the Tax Act, then you can't claim it as depreciation here. And then finally, financial arrangements and accepted financial arrangements, which is another topic that we'll talk about later. So the second stage is, well, you can only claim a deduction if you own the depreciable property. So the question is, who owns an asset? And this is particularly important for a leased asset, right? Because yes, you might pay money for an asset, but then if you technically own the asset, but then if you lease the asset to someone else and they use it and you never see the asset, you don't maintain the asset, are you actually the owner for tax purposes for depreciation? And it's a tricky question because it really depends on what the type of lease is, because there's many different types of leases, right? There's the leases, for example, at Hertz or Avis, where they rent out a car and they get it back usually within the same day or same week. And, Hertz maintains the cars, they keep the cars on premises. In any person would consider in that situation that Hertz or Avis would be the owner for tax purposes, right? And that's what you'd call an operating lease or, operating lease, because you get it back at the end of the day, and the ownership is ultimately with the lessor or the person who's leasing it out. But then you've also got other kinds of leases where it's more of a, yes, technically it's a lease on paper, but in substance what it is the person leasing the asset is leasing it to buy it. For example, if you think about leasing a car, what you're doing is you're leasing it over, say, 5 years. You're paying an amount up front, you're paying a big amount at the end, and yes, you're paying installments until that time, which constitute lease payments. But in essence, what you're doing is it's just a way of you financing the purchase of that asset, and at the end of it, you take control of that asset, so it's just a way of finance. It's like you going to the bank, taking out borrowing money for a mortgage to buy a house. You're paying the mortgage back, that's your installments, but at the end of the day, you own the house, right? So that's why we need to distinguish between the different types of leases, and in each situation, who gets to claim the depreciation expense because they own the asset. And we mean own, which we'll talk about a little bit later, but it's right here. But it's basically who is using the asset to derive their assessable income. Whoever is using the asset to derive their assessable income is the one that gets to claim the depreciation. So we've got a table down here with different types of leases, and in each situation, who generally gets to claim the depreciation on it. So if it's an operating lease like Hertz or Avis, it would be the lessor, the person who owns the car like Avis would get to claim it. If it's a finance lease where the person is just financing a car to purchase it, it's the person who's using the car or the lessee who gets to claim depreciation. Then you've also got a situation which is specific to New Zealand called a remulpa clause. You don't need to know the details of what that is, but if it's in the question, it says that the lease contains a remulpa clause, then it's the lessee again. And similar for this, where lessee of land, buildings incurs expenditure on lease fixtures or improvements to land, they are the owner of that particular asset. So basically, if you own a business but you don't own the land or the building, you're just leasing it from the owner. Typically, the owner, well, it depends what kind of lease I guess it is, but if it's like just renting a building, the owner who paid money for the asset would get to claim it. However, if you are renting the business as the lessee and you decide to put up air conditioning, for example, and you pay for that air conditioning, you are the owner of that air conditioner. You get to claim depreciation just of that asset, not of the whole building, just that particular asset that you've paid for. Section references are over there if you need them. So the next step is, per the flowchart, used or available for use. So in order to calculate depreciation, the depreciable property must be used or available for use in deriving assessable income. So just like in deductions in the earlier chapter, we discussed that in order to be an allowable deduction, there needs to be a nexus to assessable income. So just like that, the asset itself must be used for deriving assessable income for you to be able to claim depreciation. So in the case of depreciable property that is purchased prior to commencing a business, depreciation cannot be claimed until the business starts, similar to the pre-commencement issues that we came across in the deduction chapter. Next is depreciable property that is being constructed cannot be depreciated until it is used or available for use, whichever is the earlier. So yeah, you can't claim depreciation until the asset's ready to be used and is actually being used. Next, a new piece of machinery that has been delivered but is not yet installed cannot be depreciated until the installation process is completed. So again, even though you've got it sitting there and potentially you've paid for it, you can't actually claim depreciation until it's ready for use. And ready for use means being installed so you can actually use the equipment. And then finally, depreciable property that is temporarily subject to repair or inspection is treated as still available for use if it was used or available for use immediately before going for repair or inspection. So as long as you've started to use it, that means you've used it. So if it goes under for whatever reason, maybe the power blows out, you're still using it this entire period. It's just out of order temporarily, but you've satisfied the basic condition that you're using the asset, right? And as long as that initial satisfaction has been made, then you can claim depreciation throughout the entire period, even if it's down and out for repairs or maintenance, whatever it is. So the next step in the flowchart is cost, and we need to know cost because cost is going to impact our depreciation calculation, right? Because in essence, the calculation of depreciation is just your cost times your depreciation method, times your depreciation rate. And to know what your depreciation rate is, you need to know what your depreciation method is. So we'll cover those shortly. But in terms of the actual cost, and it's not as simple as just saying we paid 100 grand for the asset, therefore the cost is 100k, because there's a bunch of different issues that you'll come across in reality. So the first, obviously, the basic rule is yes, it's what you've paid, but there are some grey areas which we need to go through. So, and there's no definition of cost per the depreciation rules, but generally it's accepted that the cost is the price paid by the purchaser. Now, a new owner of a second-hand asset can claim depreciation based on the amount paid for the asset, as long as it's an arm's length sale and the transfer was not from an associated person. This is to ensure that you don't say we've only paid $100 for this asset from our friend, but the asset's worth $1 million, so we're going to claim 10% a year, 100k a year. How can you claim 100k of depreciation when you've only paid $100 for the asset? So it needs to be corresponding to what you've actually paid for the asset. So next, cost will comprise the amounts that a taxpayer has incurred in relation to the asset to bring it to its present condition and location. So this is an important point. So it may also include ancillary costs such as preliminary costs incurred in exploring the possibility of purchasing the property, delivery, shipping, and installation costs. So even though the asset costs 100 grand, if you spent 10 grand on a feasibility study, if you spent 1 grand on delivery, 2 grand on shipping, 5 grand on installation, you can include all of those costs into the initial cost base of the asset and depreciate them in aggregate. So the cost will exclude any amount that is an allowable deduction outside of the depreciation rules. For example, capitalized interest costs, which may be deductible under financial arrangement rules, or specific deductibility provision. So again, this is to prevent any double counting of certain deductions. Interest is probably a common one, which we would probably want to highlight because this probably comes across a fair bit, that if you're buying an asset, you capitalize the interest that can form part of the cost base. But if you're already claiming deduction under it, which you probably are under the financial arrangement rules, which is a later chapter that we'll go through, or some other specific deductibility, whether that's, accounting fees or something to kind of set it up to structure the business. If you've already deducted that, then you can't claim it as part of the initial cost base. What about GST? How does that kind of interact with the cost? Because, you buy an asset for 100 grand, you pay an extra GST amount on top of that. Do you just depreciate the GST exclusive amount, or do you appreciate the amount including GST? Well, it's going to depend on whether the taxpayer who's purchased the asset, is registered for GST. Because if you are registered for GST, you're already getting that GST credit through your GST returns. You're getting that money back, so you wouldn't include the GST in that case. But if you're not registered for GST and you're not going to get that credit for the GST amount, then yes, you would include the GST, and the depreciation cost base would be the GST inclusive amount. So ultimately, it's dependent on whether you're registered for GST. Now, there's also some special rules in establishing what the cost base is. So if a private asset becomes a business asset, right? So let's say you've got a personal car, and then now you've started a business and you want to transfer that car into the business to use for business purposes. The depreciation expense is calculated on the market value of the asset when it was first used in the business. So when you transfer that car in, and let's say you only paid 2 grand for it, but the value of those cars have increased since because it's a collectible car. you would now put that in at the market value. So let's say that's 10K now. You would say the cost base for depreciation is 10K, even if you didn't pay 10K for it. This doesn't apply to buildings though. If the property has been inherited, the cost price for depreciation purposes is its market value at the time the property is transferred to the new owner. When depreciable property is acquired with other assets without a separately allocated cost, for example, maybe it's buying a set of assets, the purchase price is normally allocated across the assets by agreement between the vendor and purchaser so as to reflect the respective motor vehicles. So maybe you're just buying a fleet of vehicles, you're just paying $1 million for all of the vehicles. You don't actually know what the market value is for each of those individual vehicles, which are separate assets. So what you do is you set an agreement out with the seller saying, this is the agreed price for all of the different vehicles, and then that's the price you'd accept as the starting cost. When a person acquires depreciable property from an associated vendor, i.e. someone who is related, whether by a business or common shareholding or a family member or spouse, etc., the person's depreciation base is generally the lesser of the cost of the person or the original cost of the property incurred by the associated vendor. The Commissioner has discretion to allow cost to be based on the price paid. In the case of an asset purchased from an associated vendor, i.e. person A, which had initially been purchased by person A for private purpose, but had been subsequently converted by person A to an income earning purpose, i.e. this person's purchased an asset from another person which has been converted by that other person from private to income earning purposes. So for person B, the person buying this, so person B hasn't done any of those changes. They're just merely purchasing an asset which has previously, from the seller, been converted to an income earning purpose. And if you remember above, the rule for doing that, if you do convert it, is basically to convert it to the market value of the asset. However, if you're purchasing that asset of someone else who has done that to market value, person B, i.e. the buyer, calculates the depreciable cost as the lesser of A, market value at the time of change of use by the associated vendor, or B, the cost for the associated buyer. So it's the lower of those two amounts. And if you're never sure which one is the correct answer, generally it's the answer which is most favorable to their tax office. So for example, in the previous section in trading stock, you could tell that the government wanted you to maximize your taxable income based on the valuation methods. And similarly with depreciation, because that would result in the highest assessable income and therefore the most tax. Similar with depreciation, they could have easily just said market value, but they want to minimize the taxable, the cost base of depreciable assets, because the lower the cost base of depreciable assets, the lower the depreciation cost, which is minimizing deductions, which is going to maximize taxable income. So if you're ever unsure of which one is the correct answer, it's generally the answer which maximizes taxable income is the legislation. Hopefully that helps you a little bit. Next point, depreciation method, which if we go back to the flowchart is over here. So we need to know what the depreciation method is in order to calculate the cost, because there's a couple of different depreciation methods and they result in different depreciation costs being calculated. So there's three methods prescribed per the Tax Act for calculating depreciation. There's diminishing value, number one, there's straight line method, and there's pool method. So generally once you choose which method you want to apply, and you do this in the first that you acquire the asset, and once you've filed that first return electing what method you're going to do, it's not possible to change it for that year. However, at the next year, the beginning of the subsequent year, you can change between diminishing value and straight line method if you wish. So let's go through the different calculations of these methods. So the first one is diminishing value. And just a quick note with diminishing value, you can't use this method for fixed life intangible property. Okay, you can use it for other assets, just not fixed life intangible property. For example, software, right? You've got to use straight line. So basically the way you calculate it, simple formula, it's just adjusted tax value is equal to, and adjusted tax value is basically the written down value of the asset for tax purposes at the end of the year. So the ATV is calculated as the base value of the asset, i.e. the cost. If we're in year one, it's just going to be whatever you paid for it, and any other costs bring it up to the effective to the current state as per the section we went through cost calculation, less deductions. So generally deductions for the amount of depreciation loss taken in previous years. So it's basically whatever the deduction is for interest expense, for depreciation expense for the current year, or if you're in year 2, it's the basically take last year's adjusted value less depreciation for the current year. So here's a good example to see how this calculation works. So the actual calculation is based on a percentage with diminishing value, and what this means is the rate of depreciation, whilst the 10% is fixed, relative to the dollar amount, it means that the depreciation you expense kind of goes like this, where it's highest in the first year, and then it slowly tapers out, whereas the straight line is more of just a fixed line going like this. Or I'll put up my other hand, that's a bit easier to understand. So you start off with your let's say you spend $1,000 with straight line, you get $100 depreciation each year as it comes down, so it's fairly fixed. Whereas with I'm going to use this one, with a diminishing value, it's more of a curve, right? So you get the most depreciation year 1, and because it's percentage, you're doing a percentage of a lower amount, it starts becoming less and less, right, towards the end. So it's really about, do you want to maximize your depreciation expense up front, or do you just want to even out your depreciation across the life of the asset? If you want to maximize your depreciation up front, and most people do because of the time value of money and you want the money up front, and also this is probably the method you want to use for most exam questions, which commonly say which method would maximize minimize the taxable income of the taxpayer for this particular year. Generally, you're doing this in the first year or second year of the taxpayer's acquisition of the asset. So therefore, diminishing value generally results in a higher depreciation and lower taxable income, at least if it's in the first section of its life. Obviously, the opposite is true at the later end of the life. So anyway, let's go through this example here. So year 1, they've bought an asset for $1,000. That's the cost of it. And the diminishing value depreciation rate is 10%. So how we calculate this is we just times the $1,000 by 10% equals our depreciation of $100. Therefore, our adjusted tax value, which will be basically our opening value for the next year, will be $1,000 less our $100 depreciation equals $900. Next year, the depreciation rate is going to be the opening adjusted tax value, which was $900 in the previous year, times 10% equals $90. And then now we want to calculate the adjusted tax value, which is our written down value or opening balance for next year. So you take the $900, you minus the $90, you get $810. They've written a slightly different way, but it's the same thing. All they've done is the original cost less depreciation for the entire life to date. It's the same thing as just going 900 minus 90 equals 810. Now for year 3, it's the same process. It's 810 times 10% equals 81. And then you can just go 810 minus 81 equals the 729. Now, as you can see, the depreciation is getting lower and lower and lower. So in the first year, you're actually getting, you're getting $10. Second year, you're getting $9. Third year, you'll probably get $8 and so forth. So the depreciation rate's actually decreasing. Whereas if the straight line method, it's probably getting $5 per year, $5, and so forth. So eventually, by the time you hit the 5th year, you're probably on par, but then you get to 6th year, 7th year, and all of a sudden, the straight line is getting you a greater depreciation expense. So let's go through the straight line method now. This is basically just a constant percentage of the asset's cost subtracted from the adjusted tax value. So all you're doing now is you figure out what the depreciation rate is. So let's say it's 10%, and then you get that 10% deduction, $100 every single year. So you're going $100 deduction, $100 deduction, $100 deduction every single year. So one note here is that the SL method must be used for the fixed life intangible property. We mentioned before that you can't use diminishing method for that. And likewise, if the taxpayer switches from SL method to DV method, the adjustable tax value at the end of the previous year will be used as the basis. Now, so the other way you can calculate this formula is just do the ATV divided by the effective life. The effective life is meant to reflect how many years the asset will be around and used. Now, the effective life is prescribed by the commissioner for most assets. If it's not, you just have to use the best judgment in terms of what it is. in the exam, they'll generally tell you what that effective life is. You don't need to kind of estimate it yourself. Okay, so let's move on to the pool method. So the pool method is basically a means of reducing compliance, especially for small business. And what it means is any value, whether it's low cost or low value, can be just grouped into this single pool. It means so you don't have a depreciation register of 1,000 items, which are worth like $5 each, which won't be fully depreciated until another couple of years away. So what you can do is with all those low value items, which either have a low value or low cost, just put them in this pool. And the pool, instead of depreciating individual items, what you do is you depreciate the whole pool. So you calculate what the total value of the pool is, or the adjusted tax value of the pool is, times it by your depreciation rate. That's your depreciation expense. And then the adjusted tax value for next year is the total value of the pool, less any depreciation, plus adding any assets that you've acquired or added to the pool during the year. So the general rules here is only assets with a cost or adjusted tax value of $5,000 or less each can be pooled. Or you can also apply to the commissioner for a special exemption, say, can I put this to the pool? But for most cases, it's, that's not really realistic. For most people, it's just whether it's $5,000 or less. Now, the pool is depreciated at the lowest single diminishing value rate applying to any asset in the pool. So you've got to look at all assets in the pool, look at the diminishing value rate of the lowest one in the pool, and then use that for the entire pool. So there's no restriction on the number of pools that may be set up. And items lose their identity in a pool, so it's not necessary to identify the purchase date of individual pooled assets. Newly acquired assets can be added to an existing pool, and the pool's ending adjusted taxable value is increased by the cost of the added assets. That's what I mentioned before. It's basically your opening adjusted value less your depreciation equals plus any new assets added to the pool during the year equals your closing balance or your opening balance for the next year of your adjusted tax value. So an asset that has previously been separately depreciated can be transferred to a pool, provided that its adjustable tax value at the start of the income year is $5,000 or less. In this case, both the starting and ending adjusting tax values are increased by the adjusting tax value. So this is what I was saying, that it can either be a low value or low cost. So cost is, actually it kind of covers it already up here. So a cost is when you spend money up front in year one less than $5,000, or the low value is where the adjusted tax value, because you've already depreciated it down to, let's say you bought it for $10,000 in year 3, it's finally under $5,000. Then you can add it to this pool, save yourself some compliance costs. So here's the formula for calculating the deduction for pooled assets. It's basically your rate, which remember is the lowest diminishing rate applied to any asset in that particular pool. And you times it by basically the average adjusting value for the year. You calculate that average by doing sum of the starting value plus the end value divided by 2. So that just calculates the average adjusted tax value for the year, basically. And then you times it by months over 12. Obviously, if you just started the pool in the last month of the financial year, you'd only get 1 month, not the full 12 months. Okay, so the final step of the depreciation process, just going back to this, is the depreciation rates and calculation. Right, I'll kind of combine them to the same step because after you've got the depreciation rate, it's fairly straightforward. You've got the two formulas here that tells you what the depreciation expense is. So the last step that I'm going to cover is just the depreciation rates, and this is just going to be a super simple point. It's just that you don't actually need to know the depreciation rates for the exam. They will give you that rate in the exam question, so don't worry too much about trying to memorize depreciation rates or whatever. Okay, so now we're going to talk about intangible assets. So what is an intangible asset? So it's an asset which you can't touch, right? So it's not going to be your plant and equipment, which you can physically see and touch, and it's there in your business. Your intangible assets are things like your copyrights, your patents, your goodwill. It's any rights or design registrations and things like that. So you can actually, generally you don't depreciate intangible assets, but there are some kinds of assets which are specifically, intangible assets, which are specifically listed in Schedule 14 of the Tax Act, which list out intangible assets which you can also depreciate. So that doesn't mean you can depreciate all intangible assets. Like you can't depreciate goodwill, for example, but you can depreciate certain assets like the right to use a copyright, the right to use a design, a patent or a right to a patent, the right to use to land, right to use plant or machinery, right to use trademark, management rights and licenses, consent granted under the Resource Management Act, the copyright in a sound recording if the copyright was produced, if produced or purchased by the taxpayer after 1 July 1997, and copies of the recording have been sold or offered for sale to the public, plant variety rights, design registration application, industrial artistic copyright. So fairly specific intangible assets. So just make sure in the question that you get that it is actually on the list, so you don't go down on a random tangent of intangibles and start depreciating goodwill when you can't actually do that. So if the depreciable intangible does not have a fixed life, it can be depreciated using the same methods applied to all intangible depreciable assets. For example, the right to use a computer software is depreciable under standard calc method at DV rate of 50% or SL rate of 40%. So the annual depreciation rate is set out in the formula provided below, 1 over legal life. So it's fairly similar to how you do the other, the depreciation for tangible assets, except instead of the effective life, it's going to be legal life. Fairly similar concept though, and all of this will be defined by the New Zealand government or the commissioner, and they'll be provided to you in your exam, so you just kind of plug in the rate. Alright, let's talk about immediate deduction for low value assets. So under section EE38, the full cost of certain depreciable assets, remember we're not talking about intangibles anymore, by the way, we're just talking about assets in general. Under EE38, the full cost of certain depreciable assets can be claimed as depreciation loss amount in the year of purchase if they cost less than $500. However, where a group of items is acquired at the same time from the same supplier and has the same depreciation rate, the aggregated total cost of all the items must be $500 or less to receive an immediate deduction. In terms of items that are no longer used, a taxpayer may deduct the remaining adjustable tax value of certain depreciable property that is no longer used to derive income/businesses. It does not apply to depreciable property that has been pooled or to buildings, and it's allowed when the cost of disposal of the property would exceed any consideration from its sale or other disposition. If the scrap value of assets is greater than the cost of disposing of the asset, a write-off under this section cannot be claimed. Okay, let's talk about treatment of improvements, because if you spend money on improving an asset, so let's say you've got land, and land is not depreciable, but if you then go and build, a barn on top of that land, you could depreciate the barn, right? Similarly to, if you've got an existing depreciable asset and you improve it, it could potentially be a separate asset that has its own, effective life and depreciation rate, etc. So an improvement is defined in EE67 as an alteration, extension, or repair of an item of depreciable property that increases its capital value. Section EE37 provides for an improvement to depreciable property to be treated as if it were a separate item of depreciable property in the income year in which the taxpayer makes the improvement. For subsequent income years, the taxpayer may choose to treat the improvement as a separate item of depreciable property, so you can actually record it as a different item altogether, even if it's just an extension to the existing asset, or you can do it as part of the item of depreciable property that was improved. So you have the option there. If the improvement is to be treated as part of the property, section EE37.5 sets out that if the DV method is used for the original asset, then the improvement's adjusted tax value is to be added to the original asset's adjusted tax value. So basically, you don't get to change the effective life and depreciation rate if you do add it to the existing asset. You just basically take the cost and add it to the adjusted tax value. So next year you get a greater depreciation rate for that asset. However, that's for diminishing value method. If you use the straight line method, then the improvement cost will be added to the original asset's original cost, and the depreciation rate or amount will be recalculated. All right, so let's talk about now, different section, but still under the concept of depreciable assets, is what happens if you actually dispose of a depreciable asset? Because obviously if it's a capital asset, there's no capital gains tax regime in New Zealand, so there's obviously no income arising from that. But if it is a depreciable asset, unless it was land and it got picked up by one of those exemptions we talked about in the previous chapter, what about depreciable assets? So depreciable assets cannot be depreciation deductions cannot be claimed in the year of sale or disposal of assets unless the asset is a building. So in the last year, basically the same year as you sell the asset, can't claim any depreciation on it. But what happens is there's a final adjustment on disposal made in that year to account for the loss or gain where the consideration differs from the adjusted assets adjusted tax value at sale. So basically, whatever the adjusted tax value is before you do that year of depreciation, you take that amount and you take whatever was paid for the asset, the consideration, and you do an adjustment. What's the difference between the two numbers? And you basically include that amount in your income. However, it's a little bit more complicated than that. So it's called depreciation recovery income. And it works like this. So where depreciable property is disposed of for consideration and is greater than the adjustable tax value at the date of disposal, the excess is included as income. So let's say you have been depreciating an asset and its written down value is $100. And, at that point in time, which is, 5 years after you bought it, and its written down value is $100, you then sell the asset for $150. So the difference between those two numbers is $50. But when you originally bought the asset, you sold it, you paid $200 for it, which means throughout its effective life to get to the written down value of $100, it means you've claimed $100 of depreciation throughout the life of the asset to date. Now, because the depreciation that you've claimed of $100 is greater than the clawback amount, or the gain that you've made on disposal of the depreciable asset of $50, that difference can actually be included in your assessable income, but only up to the amount of depreciation that you've previously claimed. So in this case, the limit would be $100, but they're only including $50 in the taxable income, which is the difference between the $150 sale price and the written down value. So they would actually include that $50 in their income of the taxpayer, and it would be called depreciation recovered or clawed back income per section EE 48. Now, let me give you another situation where they bought the asset for $120 originally. It's now written down to $100, so there's been $28 depreciation to date. The asset has sold for $150, so in fact they've made a gain on the asset of $50. Well, what amount would this person, the taxpayer, include in their individual tax return? The answer would be $20. So it wouldn't be the full $50 because it would be limited to the extent that depreciation has previously been claimed. So in this case, it's $20, and the rest of the $30 would be non-assessable. It just wouldn't be included. They would get that money tax-free, basically. So what about the other way? What if you actually made a loss on the asset, which is probably more common than making a gain on it? So where an asset is disposed of for an amount that is less than the adjustable taxable value at the date of its disposal, the resulting loss will be allowed as a deduction provided the asset is not a building, unless the building has been irreparably damaged and rendered useless in certain circumstances such as natural disasters. So if we bought the asset for $150, it's now written down to $100, we're selling it for $50, we'd basically get the difference, the $50 to the $100. We get a $50 loss that we can use to offset our income. This is a depreciation loss. Okay, so what about the situation when, I kind of mentioned this before, when you've got a gain in excess of the clawed back amount? So basically, if you remember before, we only have to include in our assessable income the difference between the consideration and the adjusted tax value. So if we bought the asset for $150, we depreciate it to $100, sold it for $120, we'd include the $20 in our taxable income. But it's only limited to the depreciation component. So if we made a gain of $50, but we'd only depreciated $20, that means the $30 of that gain we don't include in our assessable income. This is what this is referring to. This is the non-taxable capital gain. So generally you don't include that in your assessable income, but there are some limited circumstances in which different rules apply. See EE 44.2 for exclusions, which are listed down below. So in certain situations, depreciable property may have been deemed to have been disposed of. This is termed an event involving an item, and a calculation of a depreciation loss or depreciation recovery will be necessary where a deemed disposal occurs. So some of the events giving rise to a deemed disposal include change of use or location, loss or theft of an item, irreparable damage, repossession of an item, statutory acquisition, cessation of ownership, cessation of rights, the item living in New Zealand permanently. So these are all basically the situation at which point in time per the Tax Act, you will have to calculate what your depreciable recovery income is, what your depreciable loss is, and or what is your capital gain for that item because of this deemed disposal, even if you haven't necessarily received cash for it. Now, there's also this section over here which is able to modify special rules in certain situations. So, when there is a change in use, location of use, the consideration is the market value. So these are basically rules which change how the normal rules operate. So let's say you've received 100K consideration for your PP&E on sale, but the market value is 200K, right, for whatever reason. So when there's a change in use or location of use, it's the market value that applies rather than what was actually paid as consideration. Secondly, where property is transferred under a relationship property agreement, remember, which is to do with divorces in the court of law, the depreciable property is transferred at adjustable tax value at the beginning of the year of transfer or at cost price for any asset acquired in the year of transfer. So similar to property as we discussed in that chapter, it's just meant to ensure that the gain doesn't trigger in the event of a relationship property, and it's more just deferred until a later date, so the taxpayer is in the same position that they were if they hadn't had this divorce. And then next is in the case of a theft or loss of depreciable property or irreparably damaged property, the amount of insurance, indemnity, or compensation received is the consideration for the asset. Okay, let's talk about transfer of depreciable property between associated persons. So by now you should have a good understanding of what an associated person is. It's basically where people have the same control, they're related, etc. So it's basically not necessarily an arm's length transaction because they kind of know each other or relate to each other, and it doesn't necessarily mean that it's not an arm's length, but it's a very high chance that it is just because of that relationship. So when a taxpayer transfers a depreciable asset to an associated person, restrictions apply to the amount of depreciation that can be claimed by the new owner. The annual rate that is the new associated owner, and remember this is only for associated owners, not for random people at arm's length transactions, it's just for associates. The annual rate that the new associate owner uses is either A, a rate that is no more than the same rate used by the vendor, where the depreciation method is used, so you can't really depreciate more than the old owner, or B, commissioner has the discretion under EE 40 to allow tangible property purchased from an associate to be depreciated based on the purchase price negotiated between the associated persons if it satisfies certain rules, e.g. genuine transfer, at fair market value, permanency in transfer, where the vendor continues to retain ownership and control, commercial reasons for transfer, etc. What about when you've got an asset which is part business use, part private, like you might have a car, for example, where 2 days a week you drive it for personal purposes and 3 days a week you use it for business purposes? Well, same as you do for deductions, as we went through in that chapter, you just apportion the depreciation expense as well. So if the car is 50% private, 50% business, you would calculate what the depreciation is at 100% and then just whatever that dollar amount is times it by the business use percentage, 50%, there's your allowable deduction. But apportionment is not required where the non-business use of assets is subject to FBT, for example, where a company car is provided to an employee for private use. Okay, so let's talk about deductions for buildings and land improvements. So, effective from 2012, the depreciation rate for buildings with an estimated useful life of 50 or more is 0%. So you basically can't claim any depreciation for buildings with a useful life of more than 50 years now, whereas you used to before 2012. And in addition, there's generally no loss allowed as a deduction in the disposal of the building. So basically, you can't offset your assessable income against anything to do with the building. So the general rule in EE 48.3 is that tax losses arising on the building in the year of disposal are not allowed as a deduction. But because buildings are still depreciable property for tax purposes, i.e. they merely have a 0% depreciation tax rate, but they're still defined as depreciable property, should a building be sold for more than its adjusted tax value but less than its cost, depreciation recovery income can still arise. But I wouldn't worry too much. If you haven't depreciated anything on the property, you can't really get depreciation recovery income anyway. It's only really if you bought the building before 2012, you've had depreciation on the property, then you sell the building at a gain. It's only in that situation can you actually have depreciation recovery income arising. So don't worry too much about that. Next point, items acquired prior to 1 April 1993 are classified as excluded depreciable property. This means that they can continue to be depreciated using the pre-1993 rates, which applied at the time and for which there is no estimated useful life. So basically, if you've got a historical asset, including a building, it means you can use whatever rate was around at that time, even if today you're not allowed to claim depreciation, it's basically grandfathered out, which means using the same historical method until basically that asset is no longer available for those people, or those people die, or whatever it is, and after that, if there's no people left doing it, then it's basically the rule is gone. But you're not disadvantaging people by changing the rules in the system. That's what grandfathering is. Land is not depreciable property, but specific provisions is made for certain improvements or fixtures to land that can be depreciated. So, for example, as I mentioned before, the land's not depreciable, but if you build a bridge or a dam or a pipe or a reservoir or a tunnel or a road on your land, you can depreciate those particular assets, just not the land itself. And also, just watch out for anything to do with farmland and forestry in the question. Even though you're thinking, yes, that's land, therefore land rules apply, it's not the case, because if it's to do with farming or forestry, there's a very specific chapter on primary sector activities in the New Zealand economy, and there's very specific rules for those things. So wherever you see farm and forestry, just go straight to the primary sector's activities chapter. You skip the land section, skip the depreciation, only focus on primary sector first. And then the final point that we're going to talk about in this chapter is capital contributions. So what a capital contribution is basically it's a subsidy or similar payment paid to a person to compensate for some of the capital expenditure required. So a common example that you might come across in the real world is when a lessor makes a payment to a lessee as contribution towards the cost of their fit out. So let's say they want to enter into a 10-year lease, a tenant with their landlord, but they need to fit it out for their company. Put up the signs, put new desk in, maybe put some new dividing walls in, put new carpet in, basically get it up to scratch for their particular company. So what the landlord might do is say, well, if you sign the 10-year lease, like long term, we will contribute $500K towards the fit out, maybe half the cost. Now that's actually a capital payment. But basically what the person who received the money has to do is actually need to include that money in their tax return. To calculate how much of that money that needs to be included in the tax return, the taxpayer basically needs to divide the amount by 10, right? So it's basically, you're going to, even though you receive the cash all up front, you're going to include that income over 10 years, basically. So there is another way you can make an election to use the treatment provided in DB64, which is basically, you don't do the divide by 10 thing and include your income. What you do is the amount of the capital contribution is excluded from the item's adjusted tax base for the purpose of depreciation rules. And this just means that you'd just get $500K less of depreciation over the effective life. So if it's 10 years, you just wouldn't get the depreciation of 10 years. So it's effectively the same thing, but instead of including income over the 10 years, you're just going to prevent yourself from getting a deduction that you might have otherwise gotten over 10 years instead. But either way, you're paying for that in your tax somehow. So anyway, that's the end of the chapter. Hopefully you found that useful, and I'll see you in the next video.